Hey there, it's Mitch Goldberg. Welcome to your post-market show where you get updated on all the day's action in the market, personal finance, and basically the things that you need to know in order to keep you on the straight and narrow so that you could stick to your financial plans, your investment plans, and not make sudden hasty decisions. Today, another big update in the market. This just goes to show you why I constantly reinforce don't make hasty decisions. Oh, the market's going down. I better sell everything or sell a lot. The market's going up. I better buy a lot. Just stick with your investment plan. A good investment plan takes into consideration um, these ups and downs. Now, if the market's up or down a lot, I could see you having a rules based rebalancing plan. Like if the Dow or what are the major averages, like the S&P 500, for example, if it's down 10% or more, you could maybe have that spark an automatic rebalance where you sell out of assets that are a bigger proportion of your account and put that money into assets that are a smaller proportion of your account until you get everything back in alignment. So if you're 60% stocks, 40% bonds, and now you're 50-50, you want to knock that back down to 40% bonds and put that money into stocks to jack it back up to 60%. Okay. By the way, the S&P 500 is an index. You can't invest into an index directly, but you could invest in a security that tracks or mimics an index. So we're going to talk about a couple of these things. Let's get the right banner going. Let's roll the intro. And just while you're out there, it's a nice day in the market. So I think what we're going to do is take a look at a baby otter. Okay, and that baby otter is apparently very happy and clapping in celebration of another good day in the market. So, let's go take a look at the intro. And then we're going to talk about today's market action. We're going to look at meme stocks and the two trends. Two big things I see: a short-term indicator and a long-term indicator. One's good, one's not so good. And we'll see what we need to pay attention to. Here we go. All right, and we are back. Thank you very much. And I see a few of you are watching it. I can't tell who's watching out there. I just see the little number says there's a count that says how many people are watching. But while you're watching this, if you would, please give us a thumbs up or a heart or a celebration or a wow, whatever the reaction is depending on which platform that you're watching from. So I'm Mitch Goldberg. We're just getting started. We're talking about today's action. This is your post-market show. 4:30, Monday through Thursday. We got started a few minutes later. I was just sitting in traffic on the Northern State Parkway. There were not one, but two accidents on the way back from Great Neck to Route 110 in Melville, which is where I am now. So what can I tell you? But that's the way it goes. So you see today is just a perfect example of running on the fly or working on the fly. I was in traffic. I came up to the office, got coffee, hit the button, go live, and here we are live. So some of you may wonder what kind of prep work goes into the show. And there are times when I could make a nice thumbnail. That's that picture you see that introduces the show and says we're going live at such and such a time. I put the topic or questions that we're going to be answering. And there are days when I'm just like, I just have to hit the live button and talk to you about what's going on. And that's one of those days today. So short-term indicator is this. We talk about something called the volatility index, also known as the VIX. And what I've been telling you is if it goes under 20, we're going to continue this rally. Or you could call it a recovery off the recent lows. Regardless, we're talking about a pretty big up market. The VIX is 35. And I said, if we could see that go under 20, that gives us a whole new leg up in the market and possibly could send us to new all-time highs. And based on the trading of stocks like Apple, for example, which is right now having its best run since 2003, we could easily see the scales tip in favor of new highs in the major averages this year. And For those of you who bailed out and said, I'm getting out, there's a war, I need to, there's inflation, the Fed, Federal Reserve's jacking up interest rates. Sorry, sorry if you made a hasty move. Well, sorry, not sorry. And that's why we always push for having a portfolio that you could stick with that takes into consideration the down markets that will not be so down for you that you'll panic out and sell. That's risk tolerance. We all had a pretty high risk tolerance when the market was going up, and that risk tolerance has been whittled away since late last year, since the market's been going down. The volatility that you saw, the down market that we had up until about 3 or 4 weeks ago, that really started the day after Thanksgiving, when people started to get used to the idea that the Federal Reserve is behind the curve in terms of fighting inflation. And now you see the Fed jacking up inflation, jacking up interest rates. Okay, by the way, you check out these emoji, these social media icons. These are all the places that you can join me and reach out to me and follow me, and I could follow you. And just, these are the places where we could keep the conversation going. So if you're not following me on these platforms and you would like to see more of me, and let's say you're someone who's on Instagram a lot, then follow me over on Instagram. Let's connect. If you're on LinkedIn a lot, like I'm very big into LinkedIn, that's my jam, then let's connect on LinkedIn. But I'm on all of these platforms, and I'm always looking for comments, knowledge, sharing knowledge. And I'm also always looking for to spark new relationships and friendships in social media. And that's really cool. I've made a lot of friends on social, and I think it's really nice. I just, some people don't like social media. They're like, oh, it's all bullshit, I'm not into it. No, I really enjoy social media, and I have to say the friendships that I've made on social, they are genuine relationships, good friends, as if I met them and these people in person. We digress. So let's get back on track. Okay, back on track. So the VIX is under 20. That's what we've been talking about. We see the VIX under 20. We see the rally continue, and we are in major rally mode. Real strong, powerful rally. And it's taking everything up, from industrial stocks, economically sensitive stocks, to some stocks that are not even so economically sensitive, like consumer staples. All right. So let's take a look at where things stand in the major averages. Okay. Put myself up in the corner. I'm going to make this bigger so you can see it, because you're probably watching this on a smartphone. All right. U.S. markets, the Dow. Okay. The Dow continues to rally up another 1% today, 35,294. Okay, 35,294. Let's see what the all-time high is. Okay, 36,952. So we've got a little less than 1,700 points to go to get to an all-time high. Another 5% or so, and we're there. And based on the way things are trading, that could happen, pretty quickly. All right, so I wouldn't be surprised to see us get there. NASDAQ up almost 2%, continuing its ascent. S&P up 1.23%. Gold, which has been working, is coming right back down. Oil down a little bit at 105. It was down to like 101 earlier today, but the point is, we saw oil hit 130 twice intraday trading. That was when we decided to cut off our oil supply from Russia. And the oil came right down to the 90s. Started to rebound a little bit, but now it's coming down again. Partly oil is coming down because a major city, Shanghai in China, with something like 24 million people, which is not even the biggest city in China, basically is shut down. So China has an extraordinarily strict COVID policy, and they shut down entire industries, factories, cities, industrial regions to combat the disease. So that's what they did. But when they do that, they don't need oil all of a sudden, so it sends oil down. 10-year Treasury, the yield 2.4. It's up to about 2.5. It's 2.4. US dollar, euro dollar is up a drop. The VIX, see this? This is what we're talking about, 18.9. So we are definitely under 20. And, the lower it goes, the more the market goes up. The more the merrier, right? Let's just take a look at one other thing. I want to point out the Russell 2000, okay? This is up 2.65%, which is a really big move for a benchmark. The Russell 2K was up 55 points, all right? And the Russell 2000 follows the small cap publicly traded stocks. And that's really sensitive to the domestic economy. And that was up 2.65%, which is by far and away the best of the bunch. And that's the Russell 2000. It's the biggest index that you were probably not following, but that was up a lot. Okay. Let's take a look at crypto. Crypto's been on a big rally. I mean, Bitcoin just went from about 37,000 to 47,000. Huge rally, just about flat on the year. Some of you like the crypto and some of you don't. But I see Jerry is out there and Dan. Thank you, Jerry. Thank you, Dan. Good to see you guys. Dan, you are the social media maven. I just can't get enough of the content you put out. It's a lot of fun. Okay, so Jerry's out there. Hey, Mitch, great day. Indeed it is, my friend. And you know what's funny? I'm just thinking right now, the place where you're standing in your picture here, is that at Prime? Wow, I think Judy and I have the same picture there. Okay, that's cool. So thanks to see you, Jerry. And if any of you have any questions, please hit me up in the comments. Words of wisdom, words of encouragement, like from Jerry, are always appreciated. Everybody should have a friend like Jerry. He is such a good guy. Takes me under his wing. Bitcoin, off a little bit, but overall, I'm not too concerned about these moves. Ethereum continues to move up. No, Ethereum is down 5, big deal. But the other Ethereum, Coinbase, Gemini, depending on which, these are different. The reason you're seeing different prices for Ethereum is this is just different places where it's traded different places. Okay. Was I right, Jerry? Yes, it's Prime. I could tell by that sign over your head. Yeah, it's tough to make out, but I could tell that's the Prime sign. Absolutely. Cool. Very cool. We love, I love that place. All right, what else? Take a look at the watch list. I'm going to point to you the losers in the industrials: Deere, Lockheed Martin, Caterpillar. In particular, I want to show you Northrop Grumman and Lockheed Martin, defense contractors that have been flying higher as the war overseas in Europe, Ukraine goes on. So they're giving it back. One of the drivers to the rally is potential for a ceasefire in Ukraine. I know we'd love to see that. I don't think any of us are naive enough to believe it's going to be easy, and to think that Russia, would keep its promises. It's tough to believe. Energy stocks had an okay day. Some are up a little, some are down a little bit, but given the fact that oil was down, energy stocks are still doing well. Even where the price of oil is right now, even if it goes down to like $80 a barrel, $70 a barrel, it's still a place where oil companies can make a lot of money. So, that's why you're not seeing like massive downside in energy stocks when the cost of price per barrel of oil goes down. Okay. Let's take a look at the financials. I don't really consider Robinhood a financial. It's more like a tech company, but it had a big day today, up 24%. So it's one of the big winners of the day, albeit from a very low level where a lot of people got out. MasterCard up 5%, PayPal up, Visa was just like $200 like 2 weeks ago, and it's $228. What a move. Coinbase back over 200. Goldman Sachs, good day for the financials. All right, but I want to take a look at a few other areas. Let's take a look at the meme stocks, because those have been hot as can be lately. GameStop backed off a little bit, down 9. I put out a meme like panning the idea of GameStop going back to its old high, which was like $600. But it's been on a tear. I don't really see what they've done, if anything has changed. But some of these stocks have moved up from, very low levels, like Clover from $1.95 to $3.76. Not really my cup of tea. Not something that I really play with. AMC up to 29. AMC bought a piece of a gold mine. They raised, AMC raised all this money, and they're just throwing the money into whatever is the hot topic at the moment, and the stock goes up. And you'll probably find out one of these days that the CEO or other insiders have sold a lot of the stocks. All right, a lot of their stock. And let's take a look at the FANG M stocks. Up across the board, Apple has been on a major tear, almost up to its old high. Amazon has a long way to go, but good, okay day for Amazon. Facebook was just like 180, 190. Now it's 229. I don't know what the price would have to be for Facebook to go to for people to say, I'm back in it and it's going higher. But I would think if you could see Facebook get up to about 270, it's like a $22 stock going to 27, then, I think the stock will go to 300 and then higher if it can get to that technical level. And before someone says, and I know you are, will say, oh, it sounds like a recommendation. I'm just saying if there's certain technical levels that certain stocks need to meet. And I think a lot of people are still afraid to buy Facebook because the stock got pummeled so badly, and a major source of their ease of use in targeting customers has been eliminated by Apple. So that's why I say that. Google up 21, Microsoft, Nvidia up. Nvidia. What rhymes with Nvidia? Chlamydia. I don't even know what the F that is, but it rhymes with Nvidia. I think it's a disease. It's like a STD. It's like gonorrhea and syphilis. This show has truly gone off the rails, folks. We're talking about this stuff for no reason, just because I saw Nvidia rhymes with chlamydia. That's kind of damn having. By the way, if you didn't notice, I do have like major ADD issues, and it's kicking in hard, partly because I'm tired, partly because I'm in a rush, partly because I was in the car for over an hour. I'm not good sitting in the car for over an hour. Let's see what else we need to see. Okay. Let's take a look at the sector ETFs. All right. So real estate, the biggest winner of the day. You don't see that too often. That's inflation hedge. XL, that's how it's being used as an inflation hedge. XLK, that's tech, had a good day. Consumer discretionary, communications, which is predominantly Facebook, I think, and Netflix. XLI, industrials. There was something in it for almost everybody. Energy was the only sector that was down today, and barely down. All right. So we talked about the VIX, and the VIX gives an indicator. Short term under 20. Short term, we could see the market rally. Long term, everybody's talking about the yield curve, and the yield curve just gave potentially a significant signal, because the 5-year yield is higher than the 30-year yield. So let me explain what this means, okay? And I'm gonna pull up my markets chart, and I'm gonna go to bonds. I just want to pull up a chart. So I don't mean to not give you I don't need to look away from the screen, but I want to pull something up here, and we're going to do this now. Okay. So let's go back to the share screen. All right. Let's take a look at this. Okay. The short-term bonds is the 1 month treasury at 0.18. But generally, as you go for that, like 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, the further you go out, the higher interest rates typically go. But sometimes you go out to like the 5-year at 2.5, and then you go all the way down to the 30-year at 2.504. Not quite inverted, but flat. So a left a chart that goes from the lower left to the upper right is a positive yield. It's like going uphill. And if it's inverts, it means upper left down to lower right, it's going down a decline, going down in an angle. And when it's going down an angle, when short-term bond yields actually go a little higher than long-term bond yields, that's called an inverted yield curve or a declining yield curve. I think the declining yield curve would be a much better way to describe the situation than an inverted yield curve. But when this happens, it's a signal that economic participants have lost faith in the economy. It's a signal that banks which borrow short-term and then long-term, well, if their borrowing costs is above what they could loan the money out, banks pull back on making loans. And since banks pull back on making loans, it makes credit tighter, meaning it's harder to get loans since banks are pulling back on loans. And that can slow the economy down to the point of creating a recession. Now, the yield curve, in particular, the 2-year treasury versus the 10-year treasury, they call that the spread. The difference between the 2-year and the 10-year is the 2s, 10s spread. When the 2-year goes above the 10-year, you're in a declining yield curve or inverted yield curve. That's like the main yield curve. You could compare the 5s and the 30s. You can compare the 3 months and the 10s. But the 2s and 10s is the main one. And it's got such a good track record of predicting a recession. It's since like 1960, it's happened like 12 times. And I think one time it gave a false positive, right? It's right here. So that's why we make such a big deal about it. And you see headlines all over the place, inverted yield curve, or this part of the yield curve is inverted. A lot of people say we're not going to invert. There's a few reasons. We spoke about this yesterday, but the Federal Reserve has bought so many bonds that long-term interest rates are still artificially low. If the Fed got rid of its $9 trillion balance sheet of bonds, you'd see 10-year yields a lot higher. I saw estimates as high as 4%. And then the yield curve would be very positively sloping. So there's Fed intervention all over there's central bank intervention all over the world. There's a war going on. And the last time we had a inverted yield curve was right before 2020. And the market went down quickly because of the COVID, because COVID and the government shutdown. But there's no way that the bond market had the way to predict how bad the pandemic would be. So a lot of people are saying, no, not this time. We don't think the inverted yield curve predicts anything. And we don't think we're going into a recession. But that's the $64 trillion question. It doesn't really mean that much for the market, I don't think. If we go into recession, it means the Fed will stay easy, keep interest rates low. If we don't go into recession, well, that's good for corporate earnings. Investors are really seeing the positives to both scenarios. So the yield curve isn't really scaring anybody. The fact that it's flat or close to inverting, it doesn't seem to be having any impact. If there really was confidence that there's going to be a recession in a year and a half, we would start to see that reflected in stocks, I think, more broadly. But we're not. Market's looking really good right now. That's my story. I'm sticking to it. And I thank you all for watching. We'll see what tomorrow brings. I can't believe we are just galloping through this week. Tuesday is already over. And I thank you so much for watching tonight. All right. Take care. Bye.